that, and there's no reason because life insurance by definition is asset protected anyway. So it's not going to get attachable. It's not going to get attached because it's not attachable as an asset. Other insurance policies, the same exact concept. Whatever the intended personal or entity beneficiaries are. So what does that mean? That means if you have a homeowner's policy, well, it's the homeowners. If you have a multi-peril policy for your business, the intended beneficiary is the business. So whoever the intended beneficiaries are, there's no reason to have an intermediary entity involved in that. Family vacation, and I use family vacation compounds simply because it's been, it's certainly one of my givens. And in my context, the best way to own and I've seen it done in a number of different ways, and there are any number of ways you could potentially do it, but to get the full value of that family vacation over a multi-generational basis, family trust becomes the proper depository of that. So it's an exception because remember, I had indicated to you that if we now go back, you'll see the Talking Dog Holdings and you'll see the family trust as one of the owners of that holding company. And you'll see that not only does Talking Dog Holdings not own assets directly, it owns entities which own the assets. In addition to that, these different members, Christopher Griffin Irrevocable Trust, Megan Griffin Irrevocable Trust, these members here are not owners of assets. The asset they own happens to be the membership interest in the holding company. The exception to that, which as I just suggested, is that when it comes to your family compound, your family vacation compound, rather than putting that in the holding company, better that you have the family trust own it directly, should you ever decide to do that. Now, those are exceptions. Otherwise, to go back to it, that's the structure that you would be using. Now, I'm about to transition into turnkeys, but before I do, I want to just simply see if there are any questions related to any of that.
Yes, there are. So let me pick these up for you. Let's see. Question on the LLCs. Are these companies, these LLCs, are these series LLCs of the holding company?
I mean, are they what?
Series LLC. Series.
SERIES?
Correct.
Series LLCs.
Maybe that's not. We have those in Texas, and I assume other states. Maybe not in Florida.
No, we don't. But let me just ask you something, because that came up at one of the masterminds. Mm-hmm. I actually had somebody read the definition of it. What is it in Texas?
Well, I don't use it myself, so I'd have to pull up the definition for you, Larry.
Well, whoever asked the question, though.
That's okay. Yeah, Todd, go ahead and unmute and give Larry a little bit more context of your understanding.
So in Nevada, it's also legal, and I have multiple series LLCs, and basically it looks exactly like what you're saying is you have so I have a company that's an enterprise company, and then under it is a bunch of series LLCs. So I have one that is SSRE real estate, one that's SSRE equipment, and different things like that. So.
And yeah, and you know what? Because Todd, that came up it wasn't this last mastermind. It was because it was the one that I had actually attended in Dallas, and I didn't remember the name of it. But as we actually peeled the onion, we got down to the fact that it's just nothing other than a number of SPVs underneath a master LLC. So same structure, it just happens to be named in Nevada and in Texas. A series LLC.
Got it.
But yes, that's exactly the way that it would function.
Perfect. Another question came up, Larry. Are any of these entities that you're suggesting based or formed, say, in a state like Wyoming or the states that have any particular benefits?
Yeah, you know what? Generally speaking, I don't tend to favor that unless there's a reason. primarily because if you do it in a company, so for example, so I have a client, he's got North Carolina real estate, he's got a business he's opening in Colorado. And he happens to be in Florida. So the Florida main company is the main company is a Florida company. However, the company that he's operating outside up in Colorado, I'm creating it in Colorado. It's still a flow through. So there will still be some state tax implications, but the reality is they're going to be state tax implications anyway. So the only difference is if you form the entity in another company, in another state, you actually have twofold problems. You have to pay the tax in the state where the business is located anyway, based on the nexus rules. Plus, in addition to that, you also have to end up paying wherever you've created the entity in a different state. Plus, on top of that, you got filing fees in both states.
Right.
So I tend to favor putting it in the particular place where the actual activity is located. Now, that doesn't mean from a privacy standpoint, there are any other disclosures, if you will, if the disclosures are there are of concern. So you can handle the disclosure issue very easily. You can handle the disclosure issue by incorporation services, if you'd like. On top of that, you can certainly handle the disclosure issue by having a manager who is located outside the state in any event, and where the manager is not disclosed. So by and large, I tend to favor wherever the actual primary activity is located for whatever that particular entity is. And we're going to talk a little bit more about that when we talk about the turnkeys.
Turnkeys, yeah, exactly. Okay. Another question is, where do our retirement accounts fit in the structure, Larry?
Yeah, retirement accounts are, and you know what, I should have briefed it. I didn't brief it. But yeah, retirement accounts are very real. They're very much a part of the integrated architectural structure, but it's not part of that integrated structure. So, you know, you tend to have the two types. You have the traditional ones and you have the Roth IRAs. And virtually everything that I structure for all of my clients are all self-directed. So so you would have the self-directed account, and depending upon whether you're involved in real estate on the one side or you're involved in primarily securities, which are liquid in nature, would determine how you're actually going to do it. If it's a security, for example, in my case, I use Schwab. So every retirement account I've got, I have retirement account for just regular traditional, but primarily the Roth retirement accounts for us. And for my kids, of course, I have the traditional ones. And all of those are self-directed with Schwab. So those are in and out, in and out, in and out, and we all know the advantages of that with respect to retirement. With respect to alternative investments, such as real estate and so forth, you would use whether you're using a NewView or you use a Quest or any number of traditional self-directed administrators, you would certainly create those. So I will endeavor to identify how they fit in this structure. But yes, they're absolutely real, and they're a part of your integrated structure and really a part of your investment planning for the future.
All right, good. All right, here's a good question I was going to throw in, but our very smart members are asking the right questions. How significant is the asset protection structure if one is investing mainly in funds and syndications, and the individual has like umbrella liability insurance? So I guess we're talking about here, David Sharp, we're not talking about direct ownership of, say, turnkey properties. If I'm more passive, Larry, and I'm investing in funds and syndications, then how important is this structure from an asset protection standpoint?
Yeah, here's what I don't want you to do. I don't want you to be driven by asset protection, because asset protection is one of the three objectives that we talk about. What is appropriate in this type of structure is what I call sort of cogency of financial architecture. And one of the byproducts of that happens to be asset protection. So it is a good idea to structure it in this particular way, irrespective of whether you are particularly personally exposed to that type of that type of liability. Number two, second observation is that liability can come, and therefore exposure of assets to that liability can come from one of two places. It can either come from the activity itself, or it can come from third-party liability, where the asset at question is now otherwise susceptible to attachment. So my business is blowing up buildings. So I'm a demolition company. Well, clearly a demolition company has a high exposure to liability associated with what they do. Even if my business activity is not subjected to that. So I'm investing in syndications. Well, what liability do I have invested in syndications? Well, frankly, virtually none, because you're not exposed to decision making. The decisions are being made by a manager or a sponsor or a promoter. So your liability isn't going to come from the fund itself. However, if liability comes from a third party, the liability now has the opportunity to be able to attach from the outside, to attach whatever your interest would be in that particular fund, or at least distributions that are associated with that. So I don't want you to be thinking necessarily about asset protection being the major driver. I would prefer you to be thinking that the major driver of this structure is not necessarily exposure to liability based on what you do. That's what insurance is for. The major structure here is designed to create financial integration, financial cogency, so that your financial plan is put together. Now, with that said, your liability should be subjected to primarily, I should say, should be weighed primarily based upon what you're actually doing. There is, for example, this, and I've heard it time and time again, that you should have some type of umbrella policy that is equal to your assets. I just don't get it. I don't understand it as a concept, because when we think in those terms, we're not thinking in terms of what real insurance is. Real insurance is not a substitute for an intelligent structure. Insurance is primarily designed to protect you from those things that could potentially emanate out of the type of risk that you have related to whatever you actually do. The demolition company, somebody who is involved in the sale of securities, as opposed to somebody that's sells Converse tennis shoes in a sporting goods store. So the umbrella policy concept, which, by the way, umbrella policies are pretty expensive. So what you really want to be thinking about is an appropriate structure, number one, and measuring the extent of the insurance that you get based upon the underlying activity that's associated with that. Have a client, he bought a, in one of the towns in Florida, so on the beach, he buys one, $2 or $3 million for this house, and he puts it into VRBO, he puts it into Airbnb and all of that. And he is literally sold a bill of goods in terms of the insurance policies. And it's kind of like, good grief. I mean, you really, so number one, you need a good lease. Number two, you make sure that you have the appropriate warnings and so forth. Number three, you get normal insurance. And number four, if you really, really want to make sure that you have some type of umbrella, okay, but I don't really think that you need to have the umbrella. And on top of that, if anything, especially in a PI world, the more insurance you have, the more of a litigation bait you become in this process. So I'm not terribly concerned about the umbrella policies. I would certainly be focused more on what the activity is, which would otherwise generate that.
Okay. All right. Good.